You just retired. Congratulations. Now comes the hard part: your money, your investments, your portfolio. How do you invest when you're no longer working? For decades, financial advisors have told you the same thing: 60 stocks, 40 bonds. The 60-40 portfolio. Buy it, hold it, done. But that formula was built for a different world. Lower life expectancy, higher inflation, different tax rules. You're not your parents' retiree, and your portfolio shouldn't be either. Like this video if you've ever wondered if 60-40 is actually enough for retirement. Let me tell you why 60-40 doesn't work anymore. First, life expectancy. In the 1980s, the average retiree lived to 78. Today, you're planning for 95, 100, maybe longer. That's a 20-year difference. Your portfolio needs to work 20 years longer. Second, inflation. The old assumption was 2%. We just lived through 8% inflation. Your money needs to grow faster. Bonds alone don't cut it. Third, interest rates. When rates are low, bonds don't pay much. When rates are high, bonds lose value if you sell. You need other things working for you. Fourth, taxes. Nobody talks about this. In a 60-40 portfolio, you're paying taxes on dividend income, interest income, capital gains. It adds up. A retiree isn't just trying to grow money. They're trying to keep money after taxes. Fifth, sequence of returns risk. This is the big one. If you retire and the stock market crashes year one, you're in trouble. You pull money from a depleted account and may never recover. 60-40 doesn't account for this properly. So the question isn't whether 60-40 works. It's what actually does. Hit subscribe. I'll show you what professional planners use instead. Okay, here's what professional financial planners actually use: real-world portfolios. Layer 1, the safety bucket. This is your foundation: cash, short-term bonds, money market funds, things that don't move. This is 12 to 24 months of spending. If the market crashes tomorrow, you don't touch your stocks for years. You use this bucket. Size: usually 15 to 25% of your portfolio. Why it matters: sequence of returns risk. You're protected. You're not panic selling stocks in a crash because you're spending the cash bucket. Layer 2, the income bucket. This is intermediate term bonds, dividend paying stocks, real estate investment trusts, things that produce steady income. Your goal here is cash flow, not growth. Size: usually 30 to 40% of your portfolio. Why it matters: when the stock market dips, you still got income coming in. You're not stressed because you're not dependent on selling stocks when prices are down. Layer 3, the growth bucket. This is your long-term stocks, growth funds, index funds. This is the piece that actually grows your money over time. This is where inflation-beating returns come from. Size: usually 30 to 50% of your portfolio, depending on your timeline and risk tolerance. Why it matters: you need growth, even in retirement, especially when you might live 30 more years. This bucket handles that. Layer 4, the alternative bucket. This is where it gets interesting: private equity, hedge funds, real estate, commodities, inflation-protected securities. Things that move differently than the stock and bond market. Size: usually 10 to 20% of your portfolio, but only if you can afford it and understand it. Why it matters: diversification beyond traditional stocks and bonds. When traditional markets struggle, alternatives often don't. It smooths out returns. Now here's the key: these layers aren't separate accounts. They're strategy layers in one portfolio. Let me show you how this works in real life. Scenario: market crash happens. Year 1, stock market drops 25%. Your growth bucket gets hit. But your safety, income, and alternatives, they're fine. You're still spending from the safety bucket and getting income. The growth bucket recovers over 3 to 5 years. You never panic sell, never lock in losses. You wait it out. Scenario: inflation spikes. Your bonds are hurting, losing value as rates rise. But your growth stocks are doing okay. Your alternatives are thriving, and dividend stocks are paying more. You're not devastated because inflation isn't hitting all 4 layers equally. Scenario: you need extra money. Your kid gets sick, or you need a new roof. You need $30,000 right now. With 60-40, you might have to sell stocks in a down market. With this 4-layer approach, you pull from the appropriate bucket. If it's short-term, use safety. If long-term, use growth. You're not forced to sell at the worst time. That's the difference. It's not about returns, it's about resilience. Here's what determines your allocation: your age, health, money needed, how long you plan to live, and other income sources like Social Security and pensions. How much risk your personality can handle. I can't tell you the perfect allocation, but I can tell you this: it's not 60/40ths. The detailed breakdown, exact percentages, tax optimization, rebalancing, handling market downturns, that's in the full article. Download the Retiree Asset Allocation Guide right now. It breaks down the framework, shows real examples, and gives you a worksheet to figure out your specific allocation. Now let me tell you what I see retirees do wrong. Mistake 1, too much safety. Some retirees hold 50% in cash. That's not safe. That's a guaranteed loss to inflation. You're going to run out of money at 92. Mistake 2, too much income. Retirees chase dividend stocks like it's their job. Dividend paying doesn't always equal low risk. Some are risky. You need growth, not just yield. Mistake 3, zero alternatives. They think alternatives are only for hedge fund billionaires. Wrong. Real estate, inflation-protected bonds, and diversified strategies belong in every retiree's portfolio. Even small amounts help. Mistake 4, no rebalancing. They build a portfolio and never touch it for 10 years. Markets, needs, and timelines change. You have to rebalance at least once a year. Mistake 5, thinking past performance guarantees future results. Your advisor says, this strategy returned 8% last year. That doesn't mean it returns 8% next year. You need a framework that works in all market conditions. Mistake 6, not accounting for taxes. They chase returns and ignore taxes. You retire with a $500,000 portfolio generating $30,000 in income. If not tax optimized, you might pay $10,000 to taxes. That's a 33% drag on your income. That matters. The framework in the guide helps you avoid all of these. It's built on resilience, not returns, on outcomes, not benchmarks. Here's what I want you to do. Download the Asset Allocation Guide. Look at the 4 layers. Figure out roughly where you are. Then ask, am I protected if the market crashes? Am I keeping up with inflation? If the answer is no to either, something needs to change. Share this video with a friend who's about to retire. Come back in 1 week and tell me one thing you changed in your portfolio. Now here's the thing. Knowing the framework is one thing. Actually implementing it is different. You need to know your numbers. How much are you spending? What's your sequence of returns risk? How much do you need in the safety bucket? What tax bracket are you in? This is where professional planning comes in. Not because you can't do it, but because the stakes are too high to guess. The article goes deep on all of this. It shows real examples, walks you through the math, and gives you a worksheet to figure out your allocation. But if you want personalized planning, if you want someone to actually build this for you, that's when you talk to a financial planner who specializes in retirement. Not someone who'll pitch funds that make them money, but someone with a fiduciary duty focused on your outcomes. That matters more than you think. Grab the Asset Allocation Guide, read the examples, fill out the worksheet, then decide if you need help or can implement this yourself. Either way, do it now. Your retirement depends on getting this right. You retired. You did the work. You earned it. Now protect it. Grow it. Make it last. 60/40ths is not the answer, but this framework is. Get the guide. Do the work. Build the portfolio that actually works for retirement. You've got this. Download your free Retiree Asset Allocation Guide. Link in description.